everybody. Thank you for joining us today. So today we're joined by Darren Hodson, who is the Head of Corporate Finance at PKF. Darren's going to talk us through some of the key areas to think about when preparing a business for sale. And what we'll do, Darren will go through his presentation, and after that we'll have some questions if you have any. And the easiest way to do it probably is if you have a question, type it in the chat box, and then we'll try and read through them at the end. And we'll try and manage that appropriately at the end. There's quite a few on today, so yeah, if you can make your question pretty obvious for us there, we'll come to that. But yeah, I guess Darren, over to you then. If you want to kick off that, we'll come to questions at the end.
Okay, well, I'm going to go straight into sharing my screen. So hopefully that's come up. But firstly, thank you everybody for sharing your lunchtime with me. I haven't eaten, so I'm feeling really hungry just by saying that. I was saying to Ben just before this started, I'm quite nervous on this one, and in terms of talking you through it. And I guess part of the reason is I kind of normally run these as workshops. So this is the first time I've run it as a webinar, and the workshops allow people to take this in a direction they want to go in, because every business is different and will have its own nuances. So we try and tailor it as much as we can to the audience. So this will be this can only be generic, but hopefully there'll be some useful information in there. And if not, you can always reach out and we can always have a further discussion. Excellent, it did move forwards. So there's a little bit about me. We're going to go on to something called the exit matrix. So this is something I've thought about and designed to talk my clients through the kind of preparing for sale agenda. I've got a bit of a topic on areas where vendors fail to address, should we say, for want of a better phrase, or common themes I get when people speak to me. A little bit on unlocking higher multiples, which goes into what makes a more attractive business, and just a hard sell on the workshop afterwards. So that is very broadly the agenda for today. So from my perspective, I'm head of corporate finance at PKF. PKF is a global firm, but in the UK last year, hot off the press. These are our deal stats. We did 180 deals worth 5.6 billion. So we're all over the M&A transaction landscape. In my time, I've been a disposal specialist and consultant, driving best practice on how to sell a business. And that's kind of not only process, but how you prep businesses for sale. I've been doing this for 25 years plus. I've basically lost count. It's probably more. And from a deal value, I do basically I've done deals up to £1 billion, but PKF sit in the suite of around 1 to 250 million. So that's broadly me. So then the exit matrix. So this is really for people that are just starting out on thinking about exit and what they should think about. As I said, we'll go on to some of the points people miss. Well, clearly I'm an advisor, so I'm always going to say, get an advisory team around you. And I do believe in the statement, you don't know what you don't know. And a lot of people approach us when it's too late. And so if you speak to assemble an advisory team early, you're going to set yourself on the right course, is fundamentally what I believe. And who is an advisory team? There's people like me which provide access to buyers and shape businesses. So they're called the lead advisors. I would get a good corporate lawyer alongside you, and they will help shape and prep your business. I would get a tax advisor to sit alongside you, because actually tax is quite an important part of how you structure this. And there are ways to mitigate your tax bill, which most people think is quite important. And the fourth one, which probably less obvious, is a wealth manager. So most people go into transactions blind, not knowing what they want, not knowing how they're going to invest. And it's quite a big change going from owning a business to then owning cash. And it's a lot of pressure. So having a wealth manager that's worked with you before you've started a process is generally quite a good thing to do. The next few bits are kind of linked really to setting personal objectives and understanding your own business and understanding value drivers. And On personal objectives, there's again, we can go into so much detail on this, but what's your reason for sale? And actually having that in mind is quite important. So, for example, if you leave it too late and you suffer from ill health or you're pushing to retirement, well, guess what? You might not get best value for your business. So actually having a planning mind and thinking, well, what is it I want to achieve on an exit is quite important. As is who you want to sell to. So, do you want to sell to a trade bidder and you don't care what happens to your team and your staff afterwards? Or do you want to sell to a trade bidder that is going to protect your legacy? So mapping all of that out is quite an important part of the sales process, and I do encourage people to understand their objectives and what they want to hit. And again, having an advisor on board does, and I'm not just trying to do a hard sell on advisors, does help you kind of work through what you should be thinking about to set your objectives. The next one is valuation. So again, people don't really go and try and understand the value of their business. And that causes a problem. So the first problem is, well, they don't understand their value drivers. So what really drives the value of your business? What's going to make it more valuable to someone who buys it? Well, actually, if you don't know how your business is valued, if you don't know what the current number is, how can you drive your business today to go and maximize value? So I strongly encourage you to take advice around valuation, get it set out. There's a lot of commonality between businesses, but there are some stark differences depending on the industry you sit in. So, for example, software businesses might be valued on revenues rather than profits. Manufacturing businesses might be valued more on EBIT rather than EBITDA. So you really do have to kind of get into, what it is that drives the value of your business. And I'll touch on this in a bit more detail in a second. But also, once you know the value of your business, do you know how much you need for retirement? So, a big gap for most vendors in their thinking is, well, actually, they just guess at how much they need. They think, well, it might be 5 million I need, but we don't know. So, it comes back to this building your team. Well, a wealth manager can help you map out your retirement, can say they do long-term cash flow planning, and you build in holidays, you build in inheritance, whatever level of detail you need to go into, they can map all that out and then they come up with a number. And so that is quite an important aspect for deciding for a lot of people, because most sales are probably around retirement and what do they need. That is quite an important part, and to assess, is your value of the business right to achieve your wealth goals. And not many people really align the two. But actually, if the value of your business today is 5 million, but you need 10, well, you've got to go and do something with your business to go and extract that additional value. So you can create your business plan on the back of it. But likewise, if your wealth requirement's 5 and your valuation is 10, well, why are you still sat in the business when you wanna leave? So maybe you go a bit earlier. So these two interplay quite a lot. The fifth element of this is exit options. So I think most vendors I meet just think there's one option, which is selling 100%. but that's not true. Sorry, just taking a drink then. So one of the misconceptions is probably around a management buyout that a number of vendors come to me and say, well, I can't do a management buyout because management don't have the funds. Well, actually, again, that's not true. So the management team can go and raise money, they can go and raise debt, they can go and raise private equity. There's a whole raft of different instruments they can use these days to go and fund a deal. So a management buyout could be one of the options. But also, sometimes I have people approach me and they don't really want to exit. They're kind of maybe 50-50. And so there's something called a cash out option. So you can cash out, de-risk your business. So sell a part of it today, and then sell the other chunk at some point in the future. And people don't really recognize that as an option. I've never really understood why, but again, understanding your own exit options is quite an important part of assessing how you prepare for sale. The next one is make it easy, which is when you start getting into some of the magic. So all the rest to date is more around your personal aspirations and objectives and making sure your mindset's ready in terms of what you can and can't do. But this is probably the pivotal one, which is it's really, I can give you some simple examples, but a chairman once said to me, don't expect a buyer to take on your problems. Um, so if you've got a legal action in your company, as an example, and you emotionally you're tied into it, well, actually, the rule of thumb, if you're wanting to sell, is you've got to clear that out. You've either got to forget it or you've got to push on with the legals. You've got to clear it off the list. If your manufacturing facility is at capacity, do you think that makes it attractive for a purchaser to acquire? The answer is no, because they can't do anything with your business. Most people want to invest and to grow a company. Well, actually, if you've just left them with a problem, that's a problem they've got to pick up, and it's less likely they're gonna buy you. Why don't they just go and set something up themselves, as an example? Why don't they go and buy something else that's got the capacity? So really trying to simplify the business and make it easy, a bit like you would for a house sale. You polish it up, you make sure you iron over some of the big cracks in your company to make it attractive to somebody. And that's probably the key art of trying to get out at a good value. There are buyers that will buy rewards. So, there's all sorts of people in the marketplace, but fundamentally, most vendors want to maximize value. Well, that make it easy is critical for maximizing value. There's a bit which I go into a bit more detail on that in a second. As with management, I mean, a lot of vendors don't like to relinquish the reins. And I'm sure some of you have experienced that in the past. And actually, a bit like I was talking around exit options, if you don't invest in management, it actually takes away an exit option. And I have a philosophy of, I think the more exit options you have, the chances are that you'll be able to exit because not every business sells. But also, most bidders do not have spare management lying around. I think in the modern world, everyone feels under pressure and probably has very little capacity. So again, it kind of links into the making it easy. But if there's a ready-made management team for someone to invest in or to support or work behind, that's going to be a massive positive because it takes away a headache and also creates a bit of stability. So if someone is selling their company, by and large, they're walking away from it. Um, that's a massive risk for any buyer. So if you've got a management team that can continue and reduce that impact of goodwill, that's a huge positive. Um, my eighth point, which starts to get into some more the practicalities around how you prepare for sale, um, and that's self due diligence. So back to assembling a team early on of advisors, actually you can speak to your lawyer and you can say, I'd like the legal due diligence questionnaire that a buyer would normally go through, so I can just tick it off. And most lawyers will oblige by giving you that list, and allowing you to work through what is probably about 70 pages of things that you should be thinking about on your company. Have you got the right contracts in place? Have you got a bribery act policy? Are you complying with IR35? You know, it'll go through absolutely everything, and you can just wade through it, tick through it, and you can start to put documents aside and get things prepped for you. So you can kind of go, you can do a bit of self due diligence. And then the final one is timing, which is probably this is probably more of an art than a science, but you've got to work out your own personal timing, but also the timing for the marketplace. So um, every sector is different and has different dynamics. And so valuations go up and down, and buyer interest goes up and down. A good a good example is UK automotive industry, which is a very cyclical industry. And through the 70s and 80s was, really strong UK sector, but declined in the 90s, but has started to come back in recent years, but probably on the way down. So timing your exit for what your business does and where it sits in the marketplace is a pretty fundamental alongside your own aspirations. So this matrix, we could we could spend a lot of time on each of these different points, but that's just to give you, very helicopter view of what I think people should be thinking about when preparing for sale. Um, I think coming back to this, um, areas that vendors fail to address, I've put three or four on the side, that I think of the fundamentals. I'll probably say I rarely see these being addressed. And on the right-hand side of this slide, I've given examples of what could make your business more attractive. And so, that value drivers point, I rarely see people understanding. I mean, there's a lot of people who don't understand their own business, and that's because they've never had anybody look at it and just reflect what they think they own. And generally, it's more positive than they think. So I think a lot of owners are trying to just get by day to day operationally. And we try and move to the adage of on your business, not in your business, really understand it. And I think that's really important for how you then shape your business going forward. Um, Improving operational performance. I think again, a lot of vendors probably don't understand the need to spend to improve and reduce costs. And it seems, a lot of businesses are built on fragility rather than kind of let's move this to where it needs to be, and we put it in the right place. So I think, having an operational improvement plan is generally a good thing to try and get in place and do that early. The make it easy, I've just re-referenced here, which is I've probably covered that in enough detail in the last one, and the investment management I've covered as well. If I move on to the next slide, though, unlocking higher exit multiples. And this goes a little bit into the previous page, understanding your business and value drivers. And this can only be generic for this call, so apologies. But I've kind of built out these points to talk to clients about, which is, what really drives a multiple for a business. And in there, I'm going to start with the second one, scalability. So scalability is probably one of the key drivers of multiple. So if I just kind of step back again, so most businesses are probably sold on a multiple of EBITDA or a multiple of something. Um, so actually, if your business is a 5 times multiple today, how do you transform it? Well, actually, if you could get scalability into your business, and that is the ability for someone to come in and scale it. It doesn't mean you have to scale it. It means it's going to be easy for someone to come in and scale it. Then the chances are you will get a higher multiple for that business. So you might get a 7 times or an 8 times instead of your 5 times. So that is a pretty fundamental. And an example of that, a best example is the software sector, where if you think about it, if you develop a piece of software, let's just call it Sage 50, and you don't need to invest any further in that product, and all you have to do is take it out around the globe. Well, actually, if you're just in the UK and someone looks at that and says, do you know what, I can take this around the globe, I've got the infrastructure to do it, you're going to get a great value for that business. And scalability can apply to consultancy businesses, to people businesses. It probably means investing in some. So, as an example, AI is much more prevalent in deal making now. It's come to the fore in 2025. It's going to be a big feature going forward. And probably a lot of companies do need a bit more tech. But another one on this list is critical mass. So we talk about, how do you change the dial on your multiple again? So, um, unfortunately, in M&A, size does matter. The bigger you are, the higher the multiple you're going to get for your industry as a general rule. And the reason for that is if you're small, let's say you're doing 1 million turnover, but you're selling to a 10 billion pound business, 1 million's not going to do much for anybody unless it's got scalability. So why would they bother buying? So you're starting to limit the appetite on scale for interest in your business. So actually, chasing critical mass can be quite important to getting an end exit. Uh, on this slide as well, you've got recurring revenues. So, but why have I put that in? Well, um, a business is worth its future cash flows, which is why we basically have a multiple of earnings. So someone's doing a proxy of those future earnings. Well, actually, if you can give somebody 100 million of future earnings because it's all locked in a contract, that's going to be a very valuable asset. So a recurring revenue base is quite an important thing to try and generate as much as you can. And I know that's easy said and does depend on businesses, but just kind of flagging to you that there are more assets as a service models. You know, Rolls-Royce is now a rent the engines rather than buy the engines. You know, they've turned the model into something else. I think just to flag on other points, competitive tension has been kind of a key one for me. That's probably my biggest lever I can play in a process, which is making, don't accept the first bid, do go and speak to 2 or 3 others, do create the fear factor in bidders, and that competitive tension can drive up your multiple. But there's a whole raft of things here that go into what could be attractive, and it's not just one thing I can say to you that this is the magic for you to go and improve your exit multiple. It's a whole combination of different things, but I've kind of tried to reflect here the kind of key ones that people and buyers look at to try and make it more attractive. Just conscious of time. So just I did say I did the hard sell. I do run workshops on preparing for sale and preparing for investment. It's kind of the very similar things. The last one I run was with BGF as an example. We tend to have a very limited number of guests, but we do like to have it as more than one guest, so people learn from each other. And we run that as half-day sessions. It's basically deal teams that you can learn from the deal teams. And we try and, as I said right at the start, we try and make this as specific as possible for the audience. So it's not PowerPoints as it is today. It's an open chat around agenda items, which I've put on the right. So if people are interested, there's a QR code you can use just to sign up. Sorry, Ben. And that's probably it. So on to Q&A if anybody has any questions on that. I appreciate it's a very fast run through.
Yeah, thanks, Darren. That's great. Thank you. And we'll send a copy of this out to everybody afterwards, so you can scan the QR code later if need be. So if you're taking a picture on your screen now or whatever, we can get that over to you if that's okay. So yeah. So look in the comment box. So if you have any questions, please do put them in the chat box. We've got a couple in there already, so we'll go through a couple. So Rakesh has got a couple here. So how common is the cash out option? It seems part cash, part shares held in the buying company being most common exit nowadays to mitigate risk to the buyer. Is that still the case?
I would say I think the most common sale is 100% exit. But I do think it's partly awareness, so people aren't aware of it, and comes back to this planning point that people probably leave it too late and just they have no other option. So they haven't invested in management, or they just kind of got to that point in retirement. I just want out, and so they kind of go, let's just go down a trade route. But it's growing. I'd say it's a growing proportion of M&A in the UK. I think there's more and more awareness of it. I think that hopefully answers that question.
And on that as well, do shareholders having different requirements for an exit make it complicated, or does that put buyers off if they haven't got an alignment between them?
Yeah, I think if you've got the cash out options probably is great for where you've got unaligned shareholders. It's probably the opposite way around in that regard. So I've had clients in the past and they've come to me saying, I've got to sell. And it's like, why are you selling? It's like, well, this guy wants out and we all want to stay. Go, well, it doesn't sound like you want to sell then, does it?
Right.
In that regard, why don't we just cash out that one shareholder rather than running a trade process? We'll find the money somehow to pay the shareholder out, and you will then own the business, and we'll bring in anybody else that you want to for the forward running of the company. So the cash out option is quite good for dealing with diverse aspirations. Where the trade sale, as an example, it's generally one solution, which is everybody's cashing out.
Great stuff. Thank you. And Taryn's asked here, in valuations, is there a need to put a value on the assets of the business if that's a significant number?
So that really gets into nuances on valuation. So my approach will always be to look at net assets. It kind of depends on the industry you're in. So if you're a commercial vehicle leasing business, most of your assets are going to be on the balance sheet. But I mean, the real art of this, Taran, is you want to be trying to get goodwill. So, and that's really the point of the multiple. And so you sometimes have, and I've seen it in garden centres where the return on assets could be 1% because they're really tight businesses to go and run. And what does that mean? Well, they've actually generally got more land and assets than they should be generating profits. And apologies if anyone's got a garden centre on here, but you kind of go, well, actually, if you've got 10 million invested and you're making 1%, you're better off putting it in a bank account than the business. But in those type of scenarios, yes, you have to look at the assets, and yes, you then try and get goodwill on top. So yeah, but most businesses, especially if you're a trading entity, you probably don't look at the assets, that they're too small as a general rule versus the multiple, 5 years or 10 years of profits that you can get day one. There's probably another quirk within that, which is cash. So if you've got lots of cash and that's what's propping up your asset value, you can extract that as part of a deal in a tax efficient way. So we try and get the cash out separately. So it does depend on what the assets are as well.
Great stuff. And another question here: when would you exit through sale of shares versus sale of business assets and customer list?
So most of what I do is sale of shares, and there's just one very simple reason: tax. So if you sell shares, you get CGT rates, and you get money directly into your hands. If you sell assets, it's generally from within a corporate entity, and so that corporate entity then sells the assets. It probably has to pay tax, so corporation tax on any gain on those assets, and then you've got to get it out the business. So how do you get it out? You could bonus it out. You could put a dividend, but you straight into dividend rates, which is higher than CGT. The other way is you could liquidate the company. So you then have to liquidate it and go through a process. So you can kind of see that, but then you have to pay your CGT on what you get. So as a general rule, selling assets, customer lists is tax inefficient. But a number of caveats to that. If you're selling a group, if you're in a group and you've got a subsidiary and you're not trying to extract the cash and you just want to clear something off from the group, then absolutely, yes, sale of assets works, as does sale of customer list. But probably mostly you see sale of assets through insolvent processes. So the businesses are insolvent, so people want to leave debt behind, and the banks are trying to recover money. So that's probably where they're most prevalent.
Great stuff. Thank you. And Carl's asking, what sort of deal volumes are you seeing for SMEs at the moment?
That links back to the first slide that we had, which is we saw about 200 for us in the UK. I think volume wise, I haven't got the stat to hand, but my gut feel would say 5 to 6,000 per annum.
Yeah,
Quite a large volume. There's
good.
lots, there are lots of deals being done all the time. Deal volumes were down in 25, so versus 24, and I think 24 was down on 23. Um, but the big question probably in that is what's the expectation for 26? We think deal volumes are going to rebound. Interest rates are falling this year. The UK is seen as a stable place. The US seems to be losing its status in the world and the safety of the dollar. We're a good home for people to invest. So we're expecting more cross-border deals in the coming year.
And I'm jumping ahead here, that links into another question for Fiona. Which industries or sectors are you seeing having the most deal activity at the moment?
Oh, another impossible question.
Is it?
So I was on a call, a national call, and basically somebody listed out every sector.
Right, okay. So
So
impossible.
um,
Yeah.
I
No.
mean, we see a lot. There's been a lot around professional practice. So there's been a lot of PE investment into professional practice and consultancy sector. We had a high uptick in automotive and food and beverage, but um, it's probably quite hard to say these are the hot sectors at the moment. I think if you think about what I said at the start. I think the what will happen in 26 will be businesses that are AI ready or AI resilient will be hot for investors. So that probably cuts across every sector. But if you've got stuff like that in your business model, I think that's going to be a very strong play for you.
Good stuff. Thank you. And Bernard's asking, what's the typical time frame from start to finish on the exit matrix?
So on the exit matrix, I would say it could, well, I would say ideally you'd want at least a 3-year play. Um,
Yeah.
so to kind of prep it. And this is probably one of the issues for a vendor. So a vendor comes to us and says, I want to exit. And you go, why? I want to retire because I've had enough. And it's like, okay, can you sell it now? It's like, no. And it probably takes a year from that first meeting to get to a sale. Just as a get, you can run it faster, but you lose value. It can take longer, but just as a general rule. And so we can skip through this exit process very fast, but it's not the optimal way to do it. So a 3-year window is quite good. And I also say to vendors, allow yourself, back to this management point, most vendors haven't invested in management. So a buyer wants them to stick around afterwards. So if you've got to stick around afterwards and it's, let's say, 2 years, you need to be selling 3 years before you want to step away. And
Yeah.
then you need to be preparing probably 2 years beforehand. So it is a long window. Um,
No. Lovely. Thank you. And Chantal's asked here, what are the most important KPIs to focus on when preparing a SaaS business for sale?
um, so one of the most important, the ones that really come out for us is growth rate. So for most businesses, a 20% growth rate would be considered good, but for SaaS, that's probably not strong enough to get the high-end multiples. There's the customer churn would be the next one. So demonstrating low customer churn, basically how sticky is your customer base. Um, we're kind of live in this at the moment, and then basically a lot of people are basing their bids around both revenue and EBITDA. It used to be more prevalent just revenues, but EBITDA has become quite an important factor. Um, and margin is the other one, which is, what are your bottom line profit margins? If you sell new software or new opportunities, does it all drop through to the bottom line? I think those are the key ones that I'd have. There are other ones you can look at, but those are the key ones. And it's quite pertinent. I'm in a process at the moment doing exactly that, and those are the main things that the buyers are asking for.
Right, good stuff. Um, Thank you. And we've got last couple of questions here. So Wayne's asked, which buyer typically pays the best price? Is it PE, management buyout, or trade sale, etc.? And also Wayne's asked, do debt-free businesses make it easy to sell?
So the debt-free one's quite easy. Doesn't matter. I have a lot of vendors approach me saying I'm debt-free, and it's like, well done, type thing. But a buyer doesn't care. So a buyer normally acquires a business debt-free. So even if you had some debt in it, it'd have to be repaid. So it doesn't make it more or less attractive. It does impact your equity value. So just to quickly explain on that, if you're selling a house, you'll put it on the market for 500,000. That's your enterprise value. But if you've got debt and it's 200,000, your equity would be 300 because you've got to repay the debt. The buyer of your property for 500,000 doesn't do it. The same applies with a company. So it impacts you. So you're better off not having debt. But actually, if you need it for growth, then go and use it for growth. Um, what was the other question?
Um, which typically pays more, the
Oh
PE,
yeah.
MBO, trade sale?
So it's a hard question. So the person that should pay the most, this is my philosophy, should be a management team. So they should see the value in the business more than anybody else that in the industry. But the management team is limited by its ability to fund a deal, so therefore links back to private equity. Private equity goes through cycles, so probably less so at this point in time, but normally private equity can outbid trade because, well, actually, if trade's prepared to bid a certain number, well, why wouldn't private equity? Because they can go and get that when they go and sell, and they know that they're going to grow, so they're going to scale, so they should get a higher multiple, and that's kind of the concept. So theoretically, private equity should pay more. But in reality, I think my personal experience is if you get a sensational trade bidder on the hook, trade will pay the most. It just seems to work every time that if a trade buyer really wants it, they're going to get it.
Yeah,
Um, but it's complex, you know.
yeah, makes sense. Thank you. So we're nearly there now. So, question here from John: how do you find a suitable partner to back a management buyout? There's so many options. Are there quasi equity slash debt investors?
Yeah, I mean, you're exactly right. So um, there are thousands of different types of investors out there. I will advocate advisors. So um, basically, you've got to pick. You could. A lot of people think about private equity as access to money, and private equity talk to me saying, "I wish people would talk to me about being the right partner." So you can have different types of private equity and debt providers, but I'll stick with private equity for this bit. So a private equity house, there could be a passive one. They could invest and not want any involvement and just sit in the background. They could be an aggressive private equity, which is I want, I'm a PE firm that wants to do buy and build. I want to go and acquire more businesses and smash them all together. It could be I guess the essence of it is you've got to try and map out what you want from a partner more than just money. And when you can do that, you can then start to try and find the right people. Advisors can help you because, we live and breathe the private equity arena and the debt arena. So we can actually help you pinpoint it. But it comes back to this, what type of partner do you want? And generally, the more on debt, the more flexibility you want, the higher it's going to cost, or the more it's going to cost. So, should you get one of the main high street banks in? Maybe because you just want the cheapest solution. But if you want more debt in, or you want an easier capital repayment program, pay that bit extra and get a debt provider in. But we tend to run processes, so we say go and speak to this person, go and speak to this person, and just build that up over time, build a relationship, and you'll get to understand who these parties are. But I can't think of anywhere you can go to tell you who specializes in what, other than going to an advisor and saying, "Have you got any recommendations for me?"
Perfect. And final couple here. We'll have to stop taking questions, I think, now, but there's two here we can hopefully rattle through quickly. But from Robert, how do you find a buyer that fully values you being IA ready?
Can you repeat that? Sorry.
So, how do you find a buyer that fully values you being IA ready? I'm not sure what that means, but
What does IA ready mean?
I'm not sure,
AI
Robert.
ready.
Still on, if you can.
I think that's a typo. It's AI ready, isn't it?
I guess AI ready. Yeah, AI.
Yeah.
Sorry, Robert. Yeah, that would make more sense. AI ready. Yes.
How do you find a buyer that's fully values you being AI ready? Um, so, well, I can tell you how I do it. So, I subscribe to research databases which track transactions globally, and also databases that track appetite from firms. So, I've got that access behind a subscription paywall, and therefore I then on the back of that I create long lists and research until I get to who I think are the top 20. So I go through a really scattergun, narrowing down further and further to go who's going to pay the most for this business. So fundamentally it's research. AI has come more to the fore in deal making as well, and so you as individuals, you can use things like Copilot and ChatGPT to help you try and map out businesses globally. They don't yet link to these paywalls that I've referenced, so it doesn't. They're not quite as good as trying to get that independent research. So it's hard for you to do it as an individual. And I think that's why most vendors come to an advisor, because they're going, can you provide access to these buyers? And the advisors get the access because they pay for all the money to get the privileged data.
Gotcha. Perfect. And then the final one here, are earn-out payments 1, 2, or 3 years still popular?
Yeah. Popular for who, though, is the question. Yeah, I mean, I always go everything's negotiable, and Michael, the essence of that question is my advice is normally, are you happy with day one? If you're a seller, are you happy with day one? If not, then ignore the earn out. But I do have a lot of vendors that say I don't want an earn out. But every one of them has taken an earn out when it's been gifted to them, because it's just bunts on top versus core value. So I think, yes, earn-outs are still used, deferred consideration is still used, but really fight hard on your day one to make sure it's enough.
Makes sense. Lovely. Great stuff. We'll draw a line to the questions there. Thank you, everybody, for those questions. And thank you, Darren, for the presentation. That's really insightful. We will have a copy of this. You'll be able to access that when we can get that together and send it out, should you want to come back to it. And I'm sure Darren would happily take questions as well, should she want to contact indirectly. But thank you, everybody, for your time. And we'll look forward to seeing you next time. We've got another one planned, I think, early March. So, yeah, look forward to seeing many of you again then.